Okay, in this example we're going to look at problem 15-6 on page 810, and what we're going to be looking at is a direct financing lease, only we're going to do the accounting from it from the lessor or the company that's making the sale this time. So we have Abbott Company that leased a protein analyzer to Werner Chemical on September 30th, 2009. They had purchased the machine at a cost of $6 million. The 5-year lease agreement calls for Werner to make quarterly lease payments, of $391,548 payable each September 30th, December 31st, March 31st, and June 30th, with the first payable due that September 31st, 2009. Okay, so that makes it an annuity due. Okay, their implicit interest rate is 12%. So what we're going to do here is I just want to go through the entries that they would make. So the first thing we're going to do is we're going to record our lease receivable. So again, this is on the lessor, so they're going to not have a payable, they're going to have a receivable. And in this case, it is $6 million. We are going to credit then our inventory. Again, this is a direct financing lease, so it's not a sales lease. So we're going to take that out of inventory for $6 million. We want to record then that first interest payment, or the first payment that they make, and which was due upon receipt of equipment there. So we're going to, as a lessor, we're going to increase our cash by the lease payment of $391,548. We are also then going to credit our lease receivable for the entire balance of $391,548 because there's no interest charges because it's the first payment due, and there's been no time passed, so no interest charges. Okay, December. Let's look at then what entry would make on December 31st. So that'd be that's our second payment. And what we're doing here is we're going to do increase cash again by our $391,548. The amount of payment stays the same, but this time though we're going to have interest income, and we're going to calculate that interest income. Well, first we need to say, okay, what balance is owed on our principal yet? Well, we started off with our balance of $6 million. We subtract that first principal payment of $391,548, so we had an outstanding balance of $5,608,452. Okay, our interest payment then is going to be calculated by taking our principal amount times, remember, it's going to be a quarterly payment, so it's going to be times 0.03%, 0.03 or 3%. Our annual interest rate is 12%, so we divide that by 4 for our quarterly rate, so it's going to be 3% for the quarter. And the amount of interest that we show out there is $1,168,253 or 254, however you want to round it, if you're rounding. And then finally, the difference is going to reduce our lease receivable balance, or the principal balance that we have out there, which is going to be the difference between our interest income that we recognize and the lease receivable. So on our income statement, we're going to show interest income of $1,006,000 or $168,254. We're also going to show on our balance sheet then an ending balance of $5,440,198. It's going to be our ending lease receivable balance on our balance sheet, and that is all that's to accounting for a direct financing lease from the lessor's standpoint.